Welcome back to Insights Now. I'm David Kelly, Chief Global Strategist here at JP Morgan Asset Management. Investors on the hunt for attractive yields need look no further than high-yield credit. So far in 2025, strong corporate earnings have been a tailwind, and while concerns about the health of the economy caused spreads to widen early in the second quarter, high-yield finished the first half of 2025 up more than 4.5%. With spreads back to historically tight levels, a more meaningful economic slowdown or downward revisions to earnings could cause spreads to widen. However, attractive all-in yields should help investors look past expensive valuations and help soften the blow of any further weakness in credit spreads. Within sectors, as usual, healthcare has been at the epicenter of several policy changes, both on the equity and credit side. As with any change, there are winners and losers that emerge. On this episode of Insights Now, my co-host Gabriela Santos will be joined by Matt Nelson, a credit analyst covering healthcare and pharmaceuticals here at JP Morgan Asset Management, to discuss the outlook for the high-yield market, diving deeper into the healthcare sector. If you're listening to the audio version of this podcast, you can now watch along on YouTube by tuning into our JP Morgan Asset Management channel, linked to the show notes. Now let's get started.
Thank you so much, David. Matt, welcome to Insights Now.
Thank you for having me.
You cover issuers within the high yield space. Thought maybe we could start high level. What are you seeing for high yield overall right now in terms of fundamentals, yields, spreads? What's your take?
Sure. Yeah. Spreads in our market today are around 325, which interestingly enough is approximately where we ended the year at. We were 311 at the end of the year. But it's been a pretty volatile path to get to an unchanged spread environment over the last 6 months of the year. Through the first part of January, spreads continue to grind a little bit tighter, and we reached close to 275, which I believe is probably as tight as we've seen since before the financial crisis. And then as executive orders came out and the tariff policies were released, the market obviously became concerned about the impact on both the economy and inflation. And spreads widened over the next couple of months, about 200 basis points. So we went from the high 200s to the high 400s from late January to early May. And then as it became a little more apparent or hopeful that the tariffs were going to be more of a negotiating ploy and companies were going to have time to react and management teams were able to articulate their strategies of mitigation, the high yield market became a little more comfortable that the worst case scenario for tariffs were off the table. And spreads reversed course and have started to tighten again, and it's continued through today. So as I mentioned, we're down close to 325 in spreads now, which is near tight levels for historical range. But it's supported by a pretty stable economic outlook, default rates that continue to be below 2%.
Wow.
And a pretty strong technical, because even at low 300 spreads, the yield's above 7%, given the treasury rates are above the recent past. So 7% for institutional investors is still pretty attractive when you're looking at an equity market that's near all-time highs and arguably some stretched valuations. So we find it a good opportunity to do what we think we do best as a team, and that's security select and generate alpha in challenging market environments.
And getting to that then, you cover especially healthcare within high yield. And actually just in our previous season of the Insights Now podcast, we had Holly Morris, healthcare research analyst on our U.S. growth equity side. First off, what kind of differences are there maybe in terms of issuers you have in the high yield space versus your typical companies we think about in healthcare and that are listed more on the equity side?
Right. I think the typical healthcare companies you think at when looking at equity markets are large pharma, insurance, and medical devices. We have a little bit of all that in the high yield space. High yield companies that I follow tend to skew more towards the provider base, so hospital operators, dialysis providers, home health clinics, and some of the pharmaceutical companies we have. They're just smaller, more specialized. They maybe only have a couple products that account for the majority of their revenue, so a little riskier credit profile because of the revenue concentration. And then we have some companies that service the pharmaceutical space, so contract research organizations that run the clinical trials on an outsourced basis for both large pharma and biotech. And then we also have contract manufacturers who will manufacture the pharmaceutical products on an outsourced basis for the same client base.
So slightly different, shall we say, universe.
Yeah, we have some smaller insurance players. Some of the managed Medicaid players are in the high yield space, but obviously the United and Anthems of the world are much too large for our market.
And in terms of just looking at fundamentals, how might you look at a certain healthcare company versus how an equity research analyst would look at it?
Right. I mean, in the simplest form, we're looking at volume times price and your cost to figure out what kind of cash flow they can generate. And I would say the volume trends are probably consistent across equity and high yield companies. Right. The aging population is here. Healthcare utilization is increasing. I've been covering healthcare for 20 years and have heard about the aging population for all 20 years of that. And it's finally here. We're seeing it play through the volume. And then the pricing side. That's where healthcare can tend to get complex because there's so many different types of payers. You have commercial insurance, Medicare, and Medicaid, which are all typically going in different directions. Medicare and Medicaid, the government payers typically increase their prices on a 2-year lag. So when we saw the inflation flowing through healthcare a couple years ago, it took a couple years for Medicare pricing to catch up to what they were seeing. So now we're seeing the benefit of better Medicare pricing while the market for labor has stabilized. So margins are expanding. And then the cost side, it's basically labor and supplies on what I'm looking at on a daily basis. And the labor market has stabilized for healthcare. The nursing shortage has improved once COVID worked its way through the system. And supply costs, tariffs aside, have been pretty stable over the last several years.
And you mentioned a couple of items there for which federal policy is really important. And that's certainly been a big topic in the first half of the year in general for markets, but including for the healthcare space. Sure. How have things changed or not?
Right. Obviously, tariffs dominated the conversation at the first part of the year. And not to say healthcare is not affected by it. A lot of the companies I look at have domestic-based supply chains, so they were not going to be as impacted. There's certainly a company here or there within the high-yield healthcare space that would, some of the distributors that source their products from China were going to be impacted. They've, quickly tried to shift some of their production to onshore to mitigate that. But overall, for the healthcare market, tariffs weren't going to be a material impact. Supply costs in general for hospitals are usually around 10 to 12%. So if you saw an increase in that, it wasn't going to be a material hit to their cash flows. Medicaid, on the other hand, has been a more impactful topic. Just this morning, it looks like maybe some of the worst of the Medicaid cuts are off the table. There's been surprisingly strong Republican support for the Medicaid program. So whether they're able to actually pass what is being proposed is still in flux. But that would have more of an impact on the companies I'm looking at than the tariff situation. If you're just taking Medicaid dollars out of the system, that just flows straight through to EBITDA if you're getting lower reimbursement from Medicaid patients.
Besides federal policy, then, what are just the main fundamental drivers you're thinking about for healthcare? Is it just aging demographics? What's been going on with costs? Or are there other kind of more subsector specific themes?
Healthcare in high yield is very subsector specific. Yeah. So I feel like there's probably 10 or 12 subsectors that all are very different from each other than just calling them broadly healthcare. So each subsector has a little bit different, and it's other than the aging population. We like to say in healthcare begets healthcare. So that if you go see your doctor, they'll probably order a diagnostic scan, and the diagnostic scan may present an issue you didn't know you had. So then you go get treated for that, and then unfortunately there's complications from that on occasion. So just seeing your primary care physician starts the chain reaction of downstream services within the sector.
Oh, we've seen that.
Yeah.
All felt.
Yes, that's for sure. So I mean, for the most part in healthcare, I'm as a credit investor, we're always worried about the asymmetric risk of our investment. Our upside is capped by the nature of lending, and our downside is, you could, in theory, lose 100% of your investment in the wrong situation. So we're always underwriting situations, thinking about, if we do see policy changes, what that would mean to the company's cash flow. Are they appropriately capitalized for the amount of government revenue that they have that can change very quickly? I mean, ideally, we would like to see more commercial revenue. We view that as more stable than government that can, has pen risk to it, that it could change overnight, or a threat of changing overnight with a social media post. So ideally, we'd like to have our companies have a little more transparency of cash flows in order to take the incremental risk in some of these names.
And how about that downside bit that you mentioned in terms of when things don't go as planned? What are you seeing there, especially in terms of restructuring?
Sure. As I mentioned, default rates are pretty low. Part of that is due to the shift of companies trying to avoid bankruptcy and pursuing what we call liability management exercises, or LME. So historically, a company's operations would deteriorate to the point where liquidity would dry up and it would be unable to refinance its debt in our market, and that would force it into bankruptcy. But that's a very long and expensive process and disruptive to operations. So companies and creditors alike determined that if we could do this out of court, that would be the a better solution. So over the last several years, we've seen an increase in these LME type transactions where you find a way to restructure your cap stack outside of a bankruptcy proceeding and extend maturities and give the company runway to improve its operations. What we've also seen is the distressed debt and community come into our market and try to take advantage of those types of situations, use document flexibility to craft a deal where maybe 51% majority of creditors can benefit themselves at the expense of the 49% minority creditors. And there are some pretty troubling transactions that took place over the last couple of years. So as a counter to that, now we're seeing more cooperation agreements in our market where if things start to deteriorate, creditors are banding together and trying to get to 51% of the creditors to agree, hey, we're not going to do a transaction that is disadvantage to the other creditors in our class. And that has been successful in forcing the company to the table to talk with all creditors and not just a subset of creditors. So that has changed the dynamic a bit in the restructuring world.
And putting it together, the headlines, the long-term trends, some of the risks, what do you think are the best opportunities within high-yield healthcare?
Within high-yield healthcare, again, given the Medicaid risk, we're trying to focus on companies that have less Medicaid exposure. And that those that do, you can't avoid Medicaid in healthcare, but those that do, make sure that the companies are appropriately capitalized, lower debt to EBITDA ratios. So some of the hospitals are most exposed to Medicaid and have benefited a lot from some of the programs that are being targeted by the bill that's working its way through Congress at the moment. So, within the hospital space, we tend to stay higher quality. Tenet Healthcare is a company we've owned for a long time in our funds. It's a hospital operator and operates outpatient surgery centers as well. We find that attractive. It's lowly levered, a strong management team. And then the rest is kind of situation by situation. There are some kind of more stress situations that we continue to be involved in. But yeah, for the most part, trying to find things that you feel good in forecasting their future cash flows. And if something does happen to change, they have the capacity to withstand the volatility.
So nothing's cheap in high yield,
No.
but attractive all-in yields, general good trends within healthcare, but certainly certain risks that are always present in high yields and some healthcare-specific ones.
Yes, I think that's a good summary.
And I just am always curious a little bit about Matt and how you ended up as in the high yield space, and especially healthcare specifically.
Sure. I mean, looking back to going to school, I always loved math and numbers, and so I started at school as a math major, and a couple higher level calculus classes later, I realized that I don't love it as much as I did, or it wasn't as easy as I thought it would be. Oh. So I found another my family didn't have a business or investing background, so I wasn't familiar with some of those career paths, but went to become an accounting major. And as part of that, took a finance class. And that's when I realized, finance is the area I really am most interested in here. So became a finance major, graduated, and took a job at a consulting firm doing valuation work for small M&A transactions, litigation type damages assessment. And ultimately determined I'd rather do that for my own benefit or my own firm's benefit versus doing it for a client. So looked at the asset management side and tried to get into investing, and took a job with an insurance company just outside Indianapolis on their high yield research team. And Rob Cook, who ran that group at the time, got called by JP Morgan back in 2004 and brought a group of us over to JP Morgan to expand their high yield platform. So our core of our team has been with JP Morgan on the high yield side for 20 plus years now. And that was the point when I picked up high yield coverage. I was covering gaming, lodging, leisure companies at the time. Started to pick up the healthcare space, no medical background.
I was
so
gonna
a lot
ask,
of podcasts, a lot of different types of YouTube videos, a lot of reading of policy. So just kind of educating myself over the last 20 years on how this healthcare system works. And I eventually gave up coverage of gaming, lodging, and leisure, and now just focus on pharma and the rest of the broader healthcare space.
And specifically, healthcare is just quite nuanced to understand, isn't it?
It is, yeah.
So for you, what's a typical day like then?
A typical day, I learned long ago that if I don't exercise in the morning, I'm not going to do it. So I try to start most days with exercise before getting to the office. And then it's just spending probably an hour to 90 minutes going through sector-specific and macro news, assuming there's no major blow-ups going on, just trying to read through any of the press releases or things that got put out. And we have a morning meeting where our PMs, traders, and analysts meet kind of before the market opens. Gives analysts time to share what's happening in their market, any news that might affect trading levels for the day. And then we hear from our PMs and traders on what the agenda is for the day, anything they're specifically looking to do, and how we can assist in that process. We can bring ideas to them that fits the need. So then you ease into the bulk of your day of whatever your agenda is of talking to companies. So, and similar to all investment analysis, you're trying to build a better model, build a better forecast to figure out what these companies' credit profiles will look like 3 to 5 years from now, and whether we think the risk you take today is appropriate for what you think the forecast looks like. So we try to do that through conversations with management teams, competitors of the companies we're investing in, suppliers, vendors, other analysts. So you just try to build that mosaic that's going to help you build a more accurate forecast. So most of my day is spent talking with these different companies, reading Ks and Qs, policy pieces, and the like. And then a little unique to high yield versus equity would be we just have perpetual new issuance in our market because there's always refinancing transactions. So you may think you have an agenda for the day, and then 2 companies you didn't expect come in and launch refinancing transactions that you have to assess, talk to the PMs about, figure out if you want to participate or not. So some of the stuff you had planned to do may get pushed to the next day.
Just some curveballs.
Yes, which makes it fun. But yeah, there's always new issuance to deal with in our market and a reassessment. We most of the companies we invest in have anywhere from 3 to 10 bonds you could invest in. So you're trying to pick out where on the credit curve you want to be, whether you think the credit curve is appropriately steep or enough to extend into longer maturities. So there's a lot that goes into it beyond just, do you like the credit profile of this company?
And how long is usually the turnaround? So when they're doing a new issuance, and then when you have to commit or not?
Sure, it can vary. There's a large portion that come that are called drive-bys, so they happen day of. You learn of the deal in the morning, and they price it by the afternoon.
Wow.
Those are typically large issuers that have had a presence in our market for a long period of time. Analysts know the story well, PMs know the story well, so it's more of a discussion on what are they doing with the proceeds and where are they pricing it, and do we want to participate? But if there's an LBO that comes to our market looking for funding, or it's a new name, it could be a week or 10 days you have to look at the deal and really dig into the details and talk to management teams. So it's deal specific, but I'd say anywhere from a few hours to a week is pretty typical.
Okay. Fair enough.
Yeah.
And you mentioned LBOs, leverage buyouts, that do a lot of the issuance in your market, I suspect as well, right?
Yeah. A lot of the healthcare space is owned by private equity sponsors. So a lot of what we see in the healthcare space when it comes to private equity sponsors, we've had some spin outs from larger corporations or carve outs where they acquire a small piece of a larger corporation. We've seen physician practices have been a big part of the PE owned space, and so radiologists, oncologists, anesthesiologists, they all have these practices that are looking to roll up all of them and then push back against the insurers on pricing. So scale in healthcare surprisingly matters on pricing. So you see a lot of these companies start to roll up and acquire other systems. So there's some surgery centers that have been private equity owned in the past. So yeah, they're a material player not only in high yield but healthcare.
And how has the deal flow been going in terms of
healthcare's been a little slower for deal flow. It's been a pretty stable environment. I think trying to figure out how this administration could impact healthcare policy has probably slowed any transactions, and you don't want to look silly paying too much as a PE firm for something that could be dramatically impacted by policy changes. So there hasn't been a whole lot of M&A activity in the healthcare space. I think everyone thought more broadly it would pick up this year, and it just hasn't really materialized yet. Hopefully we get some of that. It makes for exciting deals and things to look at. So some of our PE-owned companies could be acquired, which a lot of cases that's a positive event, depending on how they structure it. But yeah, I think a little M&A would be exciting for our market.
Hopefully in the second half.
Hopefully so.
Things get a little bit more stable in terms of policy. One last question. The bonus round we usually ask, if someone wanted to know a little bit more about credit analysis or healthcare in general, what's a book, a podcast, a movie, anything that you'd recommend?
Yeah, there's no shortage of books talking about how messed up our healthcare system is and how complex it is. So you could find any of those. I wish I could find a good book to recommend that told you how to fix it. There's no shortage of ideas. I think there's a shortage of practical ideas on how to fix the healthcare system. But with that said, Peter Attia has a podcast that I listen to pretty regularly. He's a medical doctor that wrote a book on health span versus lifespan. So the idea of if you're gonna want to live to 90 or beyond, you should want to do it in a way that you're healthy and productive at that point, and not just kind of surviving for the last 10 years of your life. So I find that very interesting. I think he's pretty thought-provoking. I don't know that it necessarily influences me as an investor, but I think he gets you thinking about what the future of healthcare could look like, and the idea of not just treating these chronic conditions, but trying to find a way to prevent them and get to them early. So I would recommend I think his podcast is called The Drive. He has one with Sam Sutaria, who is the CEO of Tenet Healthcare that I mentioned earlier. They had a 2.5-hour podcast earlier this year, just talking about the state of the healthcare system and how we kind of got to here and why these different participants are in place, whether it be PBMs or insurers. And so that's helpful in just kind of a broad level set of where we are today and why we got here as a country and how our healthcare system is run.
My husband loves Peter Attia, although I had to tell him we are not doing the fasting. That's a bit too much for me.
Yeah, he throws some pretty radical ideas out there, but again, it does get you thinking.
Yeah. And in terms of an internal, any kind of JP Morgan.
Sure. I mean, it may sound like a planted answer, but the Guide to the Markets is always very helpful to me because, as a sector analyst, I can get really stuck in the weeds sometimes and really focused on healthcare and healthcare policy and not take the larger view of what's going on in the economy and how does healthcare fit into that. I just think the stuff you guys put out always has a really good provides a good historical context on what's going on in today's markets. So, yeah, I read through that most times when that comes out and always find a couple slides in there. And then when you guys present it on the Monday calls and so forth, it's always very, very helpful to me.
Oh, that's great to hear. It honestly was not planned, so thank you. And thank you so much for joining us today, for listening or for watching. And make sure to tune in and listen to our other Insights Now podcasts. This season, we're focusing on fixed income research analyst conversations, including episodes about rates, emerging market debt, municipals, and securitized debt. Hopefully, we'll see you soon. Thank you.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed J.P. Morgan Asset Management or by other areas of J.P. Morgan Chase & Co. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable, but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions and current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. J.P. Morgan Asset Management is the asset management business of J.P. Morgan Chase & Company and its affiliates worldwide.